Hi, this is Pete Andresen with Andresen & Associates. So last time we were talking about the S&P and I was pretending that it was the 1860s. Now I'm back in the office, facing reality in 2024, waiting for the inflation numbers to come in tomorrow, which makes it a great opportunity to talk about the S&P, the Standard & Poor's 500. If you remember the last video, it's an index of the largest 500 stocks in the United States economy. And it's market weighted so that the largest stocks have the largest percentage of the index. It also tends to go on 10-year runs, or multi-year runs anyway. And when the longer it's been doing well, the more overvalued it tends to become because people become very complacent about it. They start thinking there is no risk. The S&P 500, looking back in the prior years, starts to defeat all other investments. Everybody wants to be in the S&P 500, so they're just shoveling money in as it becomes overvalued and more overvalued. So it's a great trend writing investment. It can be a superb investment. However, as I pointed out, it has a few flaws which need to be reviewed. I'm going to look at some notes here because it's important to cover them all. The first thing is that it has nothing to do with quality. It's all about size. It's all about the top 500 stocks. Now, obviously, to become a large corporation, they have to sell something. But they also do a lot of stock buybacks, and a lot of passive investors just pile in. It's all about the size of the corporation for the Standard & Poor's 500. It has nothing to do with governance or wisdom, as we've all watched in recent years. Large corporations can make big mistakes. They can do a lot right as well. It has nothing to do with valuation. In other words, there's no yellow light that automatically goes on and tells you that the S&P 500 is becoming overvalued. It goes up about 2/3 of the time, and 1/3 of the time it goes down annually. That means each year. Now, most of those downturns are slight. But what I've noticed is that a lot of investors enjoy the years when it's going up, and they are very unhappy when it goes down. And the predictor of when it's going to go down may be very flawed. In fact, it may be obsolete because of Fed intervention and government spending. But the best indicator we've got is valuations. So when I dial back on the S&P 500 and our returns are lower because the stock market, the S&P 500, is overvalued, obviously there are questions. Now, it can crash, and it can crash really hard. And it can take, as you'll see, up to 25 years to get back to where we started. If we're diversified, it's a non-event because we can buy while it's down. But we have to be mindful that this thing can destroy wealth as much as it can create it. Now, keeping in mind that I think it's a wonderful investment overall. Here are 5 graphs. You know I'm a numbers guy, and so this is important to me. So let's start with that first graph. This is from A Wealth of Common Sense. Now, this one is showing us that over the long term, this is before inflation, but it's still pretty darn heroic. I mean, look at these numbers. They're awesome. The S&P is a superb long-term wealth building device most of the time. Within its venue, it is absolutely world class. Now, this next graph is from A Measure of a Plan. This is another financial blog. I'll put the link in the comments below. As you can see, stock market returns are positive about 2/3 of the time and negative about 1/3 of the time. I've learned after 38 years of investment advising that clients do the up years really well, but they do the down years less well than they think they will, usually. It's very hard to take losses. And sometimes the S&P 500 can be very, very negative. So you can lose a lot of money in the S&P 500, but that's very rare. Here's the thing, very rarely that loss is so great that it damages you emotionally and you don't recover emotionally. That's what happened to the generation that went through the Great Depression and the stock market crashes in the 1930s. This is the third graph, and that shows what happened in that time frame when, after the 1929 high, which was preceded by essentially 8 years of euphoria, 8 years of stimulus, 8 years of debt creation after World War I and the recession that cured itself in the early 1920s. This thing went on to rock. This is the Dow Jones Industrial Average, which is a precursor to the S&P 500, fewer stocks. But this one lost so much money that it took from 1929 to 1954 to recover, not including dividends. Just to break even took 25 years. This can happen, but it's only happened once. It did happen in Japan after the 1990s, but it can happen, and we need to be mindful of that. And the big indicator is valuation. So we have to be paying attention to valuation unless the world has changed, and it might have changed. Also, picture what happens if you had 50% in bonds when the stock market crashed in 1930, 1929 and 1930, and then 1933. What would happen if you had a fair amount of money diversified? And that's what this next graph shows. The S&P 500 is not the entire stock market. As you can see here, for the period of the lost decade, that's the first decade of the 21st century, other venues like small stocks and value stocks within the stock market, the larger stock market, did quite well. You can invest in places other than the S&P 500. And in fact, during times of overvaluation, historically, that's led to higher returns. And remember, if they decline less than the S&P 500 during the S&P 500's decline, then you can use money from those investments to buy the S&P 500 at a bargain. And we know that a fairly valued S&P 500 produces awesome results. Now, this is another graph of the same decade, which is only, 14 years ago. And as you can see, we, that's you and me, were invested in other things other than the S&P 500. But boy, did we have a tough time with managing our expectations in the late 1990s. If you were there for that, you might remember that. Now, okay, those are those 5 graphs. Now, what do we want to do with all this? We want to keep investing in the S&P 500. I'm using notes because this is important. It's up 2/3 of the time and it has a superb history. But we want to be diversified and we want to be mindful of risks, especially since right now it is signaling that it's overvalued. Right now, we can predict, and perhaps wrongly, that the S&P 500 may have subpar performance in the coming decade. But this kind of prediction has been wrong at least for the last 5 years because of the fact that the economy has been changed by Fed stimulus and government overspending. History tells us, though, that valuation will eventually have its predicted effect. And frankly, it tells us that the larger the overvaluation, the more exciting the reset to the mean is likely to be. But when's that going to happen? A decade from now? I don't know. I can't say. So with this in mind, to repeat what I said in the last video, I am not rebalancing or selling off our S&P 500 index fund and incurring a lot of taxes in our taxable trusts, because long term, it's reasonable to just want to ride it out. But inside of retirement plans, I am rebalancing. I am reducing our holdings on the S&P 500, even though that means we can expect lower returns until any kind of reset happens, because these are more likely to be needed. These retirement funds, the retirement money, is more likely to be needed in the next 10, 20, or 30 years, and I want it to be there for us. Also, it's a free lunch. There's no taxable effect from rebalancing, unlike in the trusts, and I feel pretty confident that valuations will probably be right yet again. Now, finally, if a correction does occur, I absolutely intend to buy in the S&P 500 index funds and ETFs, and especially I'm going to bias towards tech. How's that? The most overvalued segment of all right now. With all that in mind, please call me and let me know what you think. This is big stuff, isn't it? And tomorrow, let's see those inflation numbers. And blessings.